Good morning, John. Well, here we go with the jobless claims numbers that everybody's been keeping an eye out for, and it's pretty good news. 348,000 jobless claims. That's down from 375 the prior week. The continuing claims number, 2,820,000. We'll get that right. The number in the headline is a decrease of 29,000 from the previous week. It's the lowest revised level, the lowest level since March 14th, 2020, when it was 256,000. So we are getting back to normal in the jobless claims data. Getting there slowly but surely. The prior week was revised up to 377 from 375, so not a big deal. And the one number that I keep following and a lot of people are looking at in terms of what the long-term impact is the ongoing claims, the total number of people who are getting claims paid right now, and that drops by 311,000 to 11,743,000 in the week ending July 31st. So overall number of people who are getting jobless claims is falling. We're going to see the people who are getting the pandemic emergency claims, the gig workers fall off. And so that plays into the whole Fed question about tapering is what's the impact of that going to be when those excess numbers, when those excess benefits start to fall off. The other number out this morning, the Philadelphia Fed business outlook comes in at 19.4. That's down from 21.9. So a little bit of slowing there. Taking a look at the important numbers that we care about. The prices paid index, though, goes up 71.2 versus 69.7. And the employment index is at 32.6 versus 29.2. So more people going to get hired in the Philadelphia area, but they're going to be paying more for their supplies.
It's the right kind of downside surprise on claims. Let's whip through the price action just briefly. No real change off the back of this. We're down by 0.75% on the S&P. Futures softer. Lower, negative, Tom, by 33 on the S&P, and yields in by a couple of basis points at 123.33. Crude, as you were, we're negative still for a sixth straight session, down by 3 percentage points, Tom. $63.43.
Again, 30-year bond, 1.87%, gets my attention, well under 2%. And John and I are watching stronger dollar, 93.35 on DXY. He is optimistic. His name is Neil Dutta, and he has courageously carved an optimistic tone on the classic GDP formula. He joins us now on a day of a multiple set of glooms. Neil, within the GDP formula, what's going to come to the rescue? Is it the consumer? Is it investment, net exports? What comes to the rescue to give us a better than good outcome?
Well, I think it's inventories. When you look at the last ISM number, the customer inventories index, that looks at, respondents that are saying their current level of inventories are too low compared to too high. And it's basically at a record. So basically manufacturing survey respondents are telling you their inventory levels are too low. Basically what that means is they're going to be, working to fill those inventories, right? They need to get inventories into line with final demand. And while inventories, over long periods of time kind of net out to zero, they do in the short run contribute a lot to cyclical swings in growth. And that's going to put manufacturing production into overdrive. So, when you look at things like Philly Fed at 19.4, that's still a pretty healthy number. And so, manufacturing production is going to be a tailwind for economic activity. And as those inventories catch up to final demand, that's going to be a big tailwind for overall GDP growth.
I just took Philadelphia Fed folks off my terminal here back 15 years, and Neil's right, it's nicely above the long-term moving average. Neil Dutta, what is your GDP for 2021? We're seeing everybody market and market down. Where are you for the economic growth of the nation for this calendar year?
Yeah, I think like 6.5%, 7% is not beyond the realm of expectations. I understand that people are taking their forecast down for the third quarter. I think that's largely just a mechanical adjustment to what's going on with the Delta variant. So you have increasing COVID spread. People are taking matters into their own hands and staying away from restaurants, air travel, hotels, these sort of high-touch services. But, the people that I talk to have a time horizon that extends beyond 3 weeks. And, when I look further out, the 12 to 18 month outlook, can anyone really say that that's materially changed? If anything, you're seeing more activity getting pushed into that time frame.
Neil, this is such an important point. If you'll allow me to jump in.
Sure.
We've been talking about your point through this morning. For you and others, it's recovery delayed, not derailed. That any growth we lose in this quarter, we regain in the next quarter, in the year after that. Neil, what's the difference between a recovery that's delayed and a recovery that's derailed? What distinguishes the two things?
Well, I'm just saying there's not as much structural, changes in consumer behavior than people are expecting right now. So just extrapolating what's going on, in August isn't necessarily going to tell you much about what's going to happen next August. It may well be, John, that we're trading a bit more COVID risk now for a lot less COVID risk later. Certainly, if you look at some of the data on coronavirus, it looks like cases will probably start to peak sometime in the next week, and case growth will begin to moderate. To the extent that COVID is an issue, I think it's more of an issue in the Asia Pacific economies, right? Australia, New Zealand, certainly Vietnam, you're seeing, and so maybe that's going to exacerbate some supply chain issues. But at the end of the day, I don't think it's going to matter much for the U.S. housing situation.